Hey everyone, welcome back to Corporate Decoder, the place where we decode the jargon and mysteries of the corporate world. And let me tell you, Herc Holdings might be renting out more than just equipment. They are certainly renting out their bottom line, and it is a wild ride for this fiscal year. Alright, buckle up because we are diving deep into Herc Holdings, Inc.'s latest annual report filing with the US Securities and Exchange Commission. Think of this as the company's yearly checkup, and boy, do we have some critical results to unpack. This isn't just about numbers on a page, it is about what those numbers mean for the future of Herc Holdings, a major player in the equipment rental industry. First off, who is Herc Holdings? Well, they are a leading equipment rental supplier with a massive footprint across North America. They rent everything from aerial lifts to earth-moving machinery, and they do it across over 600 locations. Beyond rentals, they also sell used equipment, supplies, and offer services. Pretty straightforward. Right? But the real story is in the financials they've just laid out for us. Let's jump right into their financial performance for the year ending the 31st of December 2025. This is where things get really interesting. Herc Holdings reported total revenues of $4.376 billion for 2025. Now, that might sound like a lot, and it is a significant jump of 23% compared to 2024, which brought in $3.568 billion. That is nearly $1 billion increase in revenue. What does that mean? Well, the acquisition of HIE Equipment Services Inc., a huge deal completed in June 2025, clearly boosted their top line. They also opened 26 new locations. So more branches and a bigger company mean more money coming in. The core of their business, equipment rental revenue, saw a solid increase of 18%, reaching $3.77 billion in 2025, up from $3.189 billion in 2024. This growth, however, was partially offset by a 6% decrease on a pro forma basis. Meaning if you look at just the core Herc business without the acquisition's immediate impact, they actually saw a slight dip in rentals in certain markets, where their newly acquired H&E business was heavily concentrated. This hints at some market slowdowns or perhaps integration challenges with the H&I acquisition, which, by the way, added about 160 locations. Now, let's talk about sales of rental equipment. This category jumped a massive 64%, hitting $509 million in 2025, up from $311 million in 2024. This aggressive selling of used fleet helped them manage their equipment mix, likely shedding older or less profitable assets. However, the profit margin on these sales dropped from 28% in 2024 to 18% in 2025. This decrease in margin is attributed to the fair value markup on the acquired fleet they sold, and more sales happening through lower margin auction channels. This is a classic trade-off sometimes companies sell more, but make less profit on each sale to optimize the overall fleet. Now here comes a big one. Interest expense net shot up by a staggering 60% from $260 million in 2024 to $416 million in 2025. This massive increase is directly linked to the debt taken on to finance the H&I acquisition. Basically, Herc borrowed a lot of money and now they are paying a lot more in interest. This is a critical consequence of their growth strategy through acquisition. It is like buying a bigger house with a bigger mortgage. The overall asset is larger, but the monthly payments are significantly higher. And what is the bottom line net income? For 2025, Herc Holdings reported a net income of just $1 million. Compare that to 2024 when they posted $211 million. This almost complete evaporation of profit is a direct result of the massive increase in expenses, especially those transaction costs related to the H&E acquisition, which were a whopping $199 million in 2025, up from just $11 million in the prior year. The interest expense we just talked about also ate into profits. So while revenues are up, profitability has been squeezed almost to zero. Let's look at cash flow from operations, which is super important for a company's health. In 2025, they generated $1.085 billion from operations, down from $1.225 billion in 2024. This decrease of $140 million is attributed to lower profitability and those higher interest payments we discussed, plus those hefty transaction expenses. It's a concern when core operations generate less cash, especially when you've taken on more debt. The acquisition of HIE for $4.8 billion in cash and stock is clearly the dominant narrative for 2025. It added significant assets, revenue potential, and also significant debt and integration challenges. The company is essentially betting big on this acquisition to deliver future growth and synergies. Now, let's talk about risks. Every company has them, and Herc Holdings is no exception. They are heavily exposed to the cyclical nature of the construction and industrial markets, meaning if those sectors slow down, Herc feels it directly. They also face intense competition. This means they could lose customers or have to lower prices, which directly impacts their revenue and profit. The risk of not being able to integrate H&E effectively is also a major concern. If the integration is too costly, takes too long, or doesn't deliver the expected cost savings and revenue growth, it could really hurt their financial performance. Their massive debt, over $8 billion at the end of 2025, is a huge risk factor. This level of debt means a large chunk of their cash flow is dedicated to paying interest and principal, limiting their flexibility for other investments or weathering economic downturns. Despite the challenges, Herc Holdings believes its scale and diversification across industries put it in a strong position. The HI acquisition significantly increases that scale, and they are optimistic about leveraging technology and expanding their specialty equipment offerings. Their strategy is about growing what they call the core, expanding into specialized rentals, improving technology, integrating sustainability, and smartly deploying capital. The HIE acquisition is a huge part of that capital deployment strategy. Let's look at the balance sheet. Total assets ballooned from $7.877 billion in 2024 to $13.776 billion in 2025. This massive increase is primarily due to the acquisition. The company's rental equipment jumped from $4.225 billion to $5.880 billion. Intangible assets and goodwill also saw enormous increases, reflecting the value assigned to things like customer relationships and brand names from the acquired companies. On the liabilities side, long-term debt more than doubled from $4.069 billion in 2024 to $8.021 billion in 2025. This is a direct consequence of the financing for the H&E deal and other debt management activities. So, what is my take on all of this? Herc Holdings made a colossal move with the H&E acquisition. They are clearly aiming for significant growth and market leadership through scale. The revenue numbers show that strategy is translating into top-line growth. However, the cost of that growth is significant. The near zero net income for 2025, despite record revenues, highlights the immense pressure from acquisition, related expenses, and increased interest payments. They are in a crucial integration phase, and success here is paramount. If they can effectively merge HYE, cut costs, and leverage the combined scale and technology, they could see profits rebound strongly. The high debt load, though, remains a significant overhang. They need to generate substantial cash flow to manage it, especially if interest rates remain elevated. It's a high-stakes game of growth and debt management. Alright, that is our deep dive into Herc Holdings, Inc.'s latest financial report. What do you think about their aggressive acquisition strategy and its impact on profitability? Let me know your thoughts in the comments. If you found this breakdown helpful, please hit that like button, subscribe to Corporate Decoder for more insights, and definitely join our Discord community linked in the description below for even more exclusive content and discussions. Thanks for watching, and we will see you in the next decoding session.